Hello, my name is Martin Griffiths and I'm here from the Pension Services Department at Staffordshire County Council to give you an overview of the Firefighters Pension Scheme 2015. The scheme was introduced on the 1st of April 2015 and this presentation has been based on the latest information that's been provided by the Department of Communities and Local Government. Please be aware that regulations do change and do get updated. So what are we going to look at? We're going to have a look at the 2015 scheme, we're going to look at the facts, what's changing, what's remaining the same, and probably most importantly to you, how you're affected, and in particular what protections have been put in place to protect the pension benefits you've already accrued and built up in the scheme. So let's start with the basics. What sort of pension scheme have you actually got? Well, it's an occupational pension scheme, so it's offered to you by your employer, Staffordshire Fire and Rescue Authority. It's an unfunded pension scheme, which simply means that there isn't an accumulated fund there for you. So virtually every penny that comes in the form of contributions, which goes into your pension account, is then paid out to people who have previously been employed as firefighters and are now receiving pensions. It's what we call a defined benefit scheme, so everything is set out in law, and it's one of several public sector schemes. And these public sector schemes over recent years have faced reform following the work that Lord Hutton did in order to look at the cost of public sector provision for pensions. The Firefighters Pension Scheme is quite a strange naming structure, and it's become a little bit more confused as we've got more schemes that we have to manage. The first scheme, which is the one that many of you will be in, will be the 1992 scheme, and this is what we used to call the old Firefighters Pension Scheme. Then we have the 2006 scheme, and this is the one that was introduced to take account of all those who are employed in a part-time basis, such as our retained firefighters. They were actually able to come into the scheme in 2006, and that's when we had a new pension scheme. And then we have, of course, the 2015 scheme that we're talking about now. And the other scheme that we have to think about is the retained modified scheme. And this is another scheme that was introduced this year, 2015. A lot of work has actually been done following a European court case to look at all those people who were not able to join a pension scheme previously because of the hours they worked. They were given the opportunity to backdate contributions and to join a new pension scheme arrangement, which is the retained modified scheme. But we will mention a little bit more about that later. So what's not changed in the pension scheme? Well, it's remained a statutory scheme. The benefits are defined. You get tax relief on your contributions. When you come to retire, you also have the option to take a tax-free cash lump sum by giving up some of the pension that you've earned. The pension you've got will be index linked. You've got built-in life cover and ill health benefits. There's pension for your partners and for your children. The employer also pays a contribution rate into the scheme on your behalf, and it really is great value for money. If you had to buy a comparable pension in the private sector, you will be required to pay far more in the way of contributions. What is new though? So in the 2015 scheme, in all the new schemes, in fact, for the public sector, we've actually moved from final salary arrangements to career average arrangements, and we're going to discuss about how that works a little later. You have a new accrual rate, which is 159.7. We'll talk about that again as well. You have something called a pension account, and this is what you build up. So every year going forward from the 1st of April 2015, you are building up an additional pension year on year, and that goes into your pension account. You have protection against inflation. You have a new retirement age, which is age 60. There's the opportunity to take partial retirement from age 55. And your deferred pension age has actually now been linked directly with your state pension age. So that could differ for everybody watching. It could be anything between 65 and 68, and this date could change going forward. So let's do a brief summary. Your pension's based on 1/59.7 of your pay. You'll have an individual pension account. You'll get family and dependents benefits. There's ill health cover, death in service benefits, and cost of living increases will be applied to your benefits annually. So let's have a look at the care calculation and how it works. We've got an illustration of a cake there on the side, which is a good way of explaining the care system. So each year a slice of pension, like the slice of cake, based on your salary is built up. So you're moving it from the main cake to a separate pension account on the side. Your pension is increased each year with a revaluation rate until you reach retirement. So the value of your pension when it's initially built up is retained going forward. Now you have a set retirement date. If you decide to take your pension benefits before that point, it is important to note that your 2015 benefits that are accrued under the scheme would actually face an early retirement penalty. In other words, it will be reduced. So how does the scheme work? So we've got a calculation for you here on the screen. Let's have a look. The calculation, as we said, is 1/59.7. The 1 represents the rate of pay that you earn in that particular year. So in the calculation, if you had earnings of 30,000, it's simply 30,000 divided by 59.7, which gives you an annual pension build-up in that year of £502, and that will be added to your pension account. Now, as we said, we have to ensure that that £502 is worth the same in the year that you build it up as when you come to receive it when you retire. So it's actually increased by the average weekly earnings index, and in this example we've used 3%. So 3% of £502 is an additional £15.06. So in April, if you add that amount to your existing £502, means the total pension build-up in that year is £517.06. So how does the main scheme work in connection with what you've had before? Well, if you were in the 1992 scheme previously, you realised that there was a ceiling on the amount of pension build-up that you could have, which was 30 years. But that no longer applies, and going forward there is no cap on the amount of pension you can actually earn in the 2015 scheme. Also on this slide we've got a note about assumed pensionable pay, and this is important particularly with the build-up of a care pension, because if in one particular year, one slice of that cake, you've perhaps been away, perhaps you've been off sick, due to an injury or just any other period of sickness, or you've been away on maternity or paternity or adoption leave, during that 12-month period you wouldn't have built up as much pension as normal. Therefore you would be disadvantaged going forward. And in order to prevent that from happening, we asked for a pay figure from your employer for that particular year of the value of pay you would have received had you not been absent. And so the pay figure that we look for is your assumed pensionable pay figure. And if you ever heard that terminology, that's actually what we're referring to. So what does this new scheme mean to you? Well, there's actually 3 main categories of members, and you'll fall into one of these categories. The first categories are the very lucky people. They're the ones that are fully protected. Now, in order to be fully protected, you will have been within 10 years of your current normal pension age. If you're in the 92 scheme, you would have had to have been age 45 on the 1st of April 2012. And if you're in the 2006 scheme, you would have been age 50 or more on the 1st of April 2012. And for those people, they will remain in their respective schemes going forward. They will not be moving into the 2015 scheme. The next group are what we call the phased or tapered group, and these individuals, which are people in the 92 scheme between 41 and 45 on the 1st of April 2012, and those in the 2006 scheme who are between 46 and 50 on the 1st of April 2012. If you fall into that category, currently you will remain in your respective scheme, but as time passes and as you get older, you will be moved into the 2015 scheme. And our third group are those who have no protection at all and who will have been moved into the 2015 arrangement from the 1st of April 2015. When we were looking at the different schemes that we had, the 92, the 2006 scheme, the other main scheme that we actually had was actually the scheme for the modified retained firefighters. This scheme was also new this year, and this is for the individual firefighters who had been disadvantaged previously by not being allowed to join a pension scheme, or particularly not until 2006 when they became eligible. Now for these individuals the same things apply. Therefore those not protected will have been moved into the 2015 scheme from 1st of April 2015, or from their appropriate taper date, which will be at a later point. Anybody in the modified retained scheme will find that their normal retirement age is age 55, very like those who were members of the 1992 scheme, which was the upper limit of their retirement age. There has been some confusion with people who are actually part of the modified retained firefighter scheme. When you actually elected to repay your contributions to cover your missed periods of service, contributions will have been deducted. It's important to note though that you, by electing to pay those extra contributions, you're not only paying the backdated contributions, you're paying the contributions going forward to be a member of this particular scheme, the modified retained firefighter scheme. So you may find that in the initial points that contributions are deducted, you will see two lots of contributions taken. If you do have any queries on your contributions, you need to refer those to the payroll section, of your fire authority. What about the benefits you've accrued before April 2015? Now it's important to note that anything that you built up, for example in the 2006 or the 1992 scheme, will be calculated still based on your final salary at retirement, and it is your final salary at retirement, not the final salary you were on as at April 2015 or March 2015. It's the salary you're on when you actually come to retire, and this will be added to the benefits you earn in the 2015 care scheme. As far as contribution rates are concerned, we have 4 contribution rates or pay bands. Retained or volunteer firefighters' contributions are based on their reference pay, and part-time firefighters' contributions are based on the whole-time equivalent pay that they would actually receive. So how do we work out your pension when you actually come to retire? Now on this slide we've got an example of a piggy bank, or this could be your pension account, which we've talked about previously. And all those little years falling into the piggy bank, or little coins, relate to the new care scheme pension. So in year 1 is the first year of pension that you build up, which will be from the 1st of April 2015 to the 31st of March 2016. Then your next year is 16-17, year 3 is 17-18, etc. In addition to those amounts of pension that you build up in each particular year, you'll have your previous final salary pension. You'll have any pension that you have accrued as a result of any transferred in membership. And then remember, when you finally come to retire, you have the option to commute some of your pension or give up some of your pension to provide a lump sum. Changes in pensionable pay. For the 2015 scheme, it's important to note that pay for temporary promotion will not be pensionable. This is different to how we looked at it under the 2006 and 1992 scheme, where it provided you with a benefit under the APB arrangement. So currently you may well still be getting the benefit from a temporary promotion while you're still contributing to the 92 and 2006 scheme, but as soon as you move over into the 2015 scheme, this will no longer apply. You will, however, you lose the APB benefit you have built up. So when can you retire? Okay, so your normal pension age in the 2015 scheme is age 60. If you retire before your normal pension age, your 2015 benefits, that's what we're particularly talking about here, will be reduced. The benefits, however, you have accrued already in the 1992 and 2006 schemes remain at their existing normal pension age, which is between 50 and 55 for the 92 scheme and age 60 for the 2006 scheme. There is nothing to stop you if you were in the 1992 scheme currently thinking, well, I've always wanted to retire at age 51, so that's what I'm going to do. There's nothing to stop you actually drawing your 1992 benefits at that age because you retain that retirement age. However, any benefits you've accrued in the 2015 scheme cannot be drawn at that point, and they would remain deferred in the pension scheme. The earliest point you could draw those deferred benefits would actually be age 55, and even at that point they would face a reduction, but you could still draw them at that point. Once you reach age 60 plus, you can immediately access the benefits you've accrued in the 2015 scheme. Partial retirement. This is something new for the 2015 scheme, and it allows members to take their pension at age 55 without actually leaving employment. It's important to remember that you will receive a reduction to that pension that's actually paid out, but during that time and going forward you would continue to build up more pension. If you're in the 1992 or 2006 schemes, however, the member would actually be required to retire fully in order to actually access their benefits. Employer initiated retirement. This is where an active member, age 55 or over, but not having attained normal pension age, is dismissed or terminated by mutual consent on the grounds of business efficiency. Under these circumstances, the pension can be paid without any early payment reduction, so it would be paid straight away providing you are over 55 or over, and you wouldn't face a reduction to the value of those benefits. The double accrual guarantee. It's important for anybody who was currently or previously in the 1992 scheme, because as you will aware, you had a fast accrual system. So what happens within your first 20 years of service, you built up pension at the rate of 1/60th. Then for any subsequent years after that, pension was built up at the rate of 2/60th, up to a maximum of 40/60th, and that guarantee is retained. Your deferred benefits, now we've mentioned those briefly previously. A deferred benefit is something that you build up, but you can't access immediately because you leave before normal pension age. So your new age at which you can access your deferred benefit is actually your state pension age, and the state pension age will differ for every individual, and going forward the age at which you can access those benefits, because as state pension age increases, so will the point that you can actually access your benefits. Currently the maximum or the highest age for accessing your state benefits is age 68. You can take them from age 55, as we've also mentioned before, but you do need to be aware that they will actually be reduced. They can also be brought into payment on health grounds in conjunction with discussions with your employer, or also for another reason, but you do have to have your scheme manager's approval. So that's under the scheme manager's discretion. This slide talks about actuarial reductions and increases. And all we're really saying here is that a reduction will apply to the value of your benefits from the 2015 scheme if you were to retire between 55 and 59. As you're aware, normal retirement age is 60, so you're drawing your benefits early and they're paid for a longer period of time and therefore will need to be reduced. If you don't take them until after your normal pension age of 60, they will face a slight increase to their value because you're drawing them at a later point. Options for your lump sum. I'm sure you're fully aware of when you can actually give up some of your pension to get a lump sum payment. This is very similar to the arrangements under the 2006 scheme. You can actually commute up to 25% of your pension, subject to HMRC limits, and for every pound you give up, you'll be given £12 of tax-free lump sum cash, and that's exactly the same for the 2015 scheme going forward. Ill health retirement. There's very little change with ill health retirement. There's no change to fitness or capability tests. It's still a matter for your employer. So at the end of the day, your employer will decide whether to grant an ill health retirement. There are some ongoing discussions nationally with regard to how to manage fitness and medical capability in the workplace. So you need to be aware that those are taking place currently. This slide goes into a bit of detail for you about how we calculate ill health benefits, and it points out there that we have two tiers of benefits. We have a lower tier of benefit and a higher tier of benefit, depending on your degree of disability or illness. Will depend on which of those you're awarded, and a recommendation will be made by the occupational health physician to your employer about which one of those you should be awarded. Death benefits. Death in service lump sum is 3 times your final pay, and the death on pension guarantee is 5 years, and that simply means that there's a 5-year guarantee on the value of the pension that we will pay. So for example, if you die after 1 year of going on to retirement, the balance of 4 years will need to be paid out from the pension fund. Survivors' pension benefits. Well, they're payable to your spouse, to your civil partner, to a cohabiting partner, although certain conditions do apply. We've also got something called a wide age disparity clause. This applies to the payment of, for example, cohabiting or spouse or civil partner's benefits if there is a difference between your age and your spouse or civil partner's age of more than 12 years. If that does apply, there is a slight decrease to the value of pension that they will receive. You also receive pensions for your children and any other eligible children covered by the pension scheme regulations. Added pension contributions. If you've previously taken out a contract with the Fire Authority to buy additional 60ths, those contracts will continue and will remain in force, and we will continue to deduct the contributions, and you'll be awarded the relevant 60ths that apply. If you've never taken out a contract, there's still the option for you to do so, and you can take out the option to buy additional pension under the 2015 scheme, and that is in line with the guidance we are given by the Government Actuaries Department. Please remember that despite the changes, despite the introduction of this new scheme, it's still a defined benefit, so you know at the end of the day what you're going to get. It's an excellent, safe scheme. It's an index-linked pension scheme for both you and for your dependents. There is very good death in service cover, and there's benefits should your health fail in the case of an ill health pension. If you have any queries in relation to the new Firefighters Pension Scheme 2015, please feel free to contact the Fire Pension team. The office location is given on this slide, and also the telephone number. The final slide is just a disclaimer, just making it clear that the information that we are giving you today is based on the current information that we hold. Thank you very much for listening.